So let's talk about the difference between a crash, bear market, recession, and depression, and how we as investors should react during each. Let's dive in. So a crash is when the market goes down 10%. It's typically very abrupt. I usually say within 30 days or less. Some people may contest that, but it's typically very abrupt. A great example of this would be what I would call the COVID-19 dip of 2020. So when that happened, it was about February, March. The market went down about 30%. It was very abrupt. But within 3 months, the market already corrected to all-time high. So it's a very short time period. 30% down and right back up. So that would be a crash. Bear market is when the market goes down 20%, can be abrupt, can be a little extended, but typically less than 2 consecutive quarters. So 20% down, again, can be abrupt, but can be a little extended. Now you get to category 3. This would be recession. Recession is when you have 2 consecutive down quarters. Now, end of 2021 through 2022 and a little bit of 2023, I would classify that as a recession. The reason is we had more than 2 consecutive quarters down. There's a lot of people out there that contest that because we had pretty low unemployment. Typically, when you have a recession, you'll have higher unemployment. Well, it's pretty low. So that's why there's this gray area. Like, was this a recession? Was this a bear market? In my opinion, really doesn't matter what you call it. It's still, and we'll get to this at the end of the video, still a good time for us to act as investors. Then you get to the fourth category, which is a depression. Depression would be 3 years down or a 10% decline in GDP. I usually lean on that 3-year decline. And they're very rare. Depressions do not happen often. So here's perspective. Over the last 100 years, there have been about 19 bear markets / recessions. So that's at category 2 and 3. And the average duration has been about 9 months. So they don't happen often. A great example of this was in 2008, the Great Recession. The market went down about 38%. But in 2009, the market already corrected. I think it was about 24%. So that was definitely recession. It was more than 2 consecutive down quarters, but it was far from a depression. It was down and then right back up. I know these moments feel painful, but they typically don't last that long. So keep in mind, over the last 100 years, 19 bear markets / recessions, and they usually last 9 months. Now, over the last 100 years, we've had one depression. That's the event between 1929, 1939, and World War II got us out of that event. So those are the differences between the four. Now, what should we be doing as investors? No matter what, no matter if it's a crash, bear market, recession, or depression, these are the best times to buy. As investors, we are buying great businesses. In most cases, we don't care what the market's doing. We care about the businesses we invest in. That's why we use a platform like Tykr to really see through the clutter, understand the financials. A good business is constantly selling no matter what the market is doing, and that's going to reflect on that income statement, cash flow statement, and balance sheet, and that's what Tykr looks at. So these are great businesses. We want to be buying more because I tell you what, you can't get a better deal in the market than when you have a crash, bear market, recession, or depression. If you like this video, hit that like button. If you want to see more like it, hit the subscribe button. If you want to learn more about investing, please go to Tykr.com. We'll see you in the next video. Bye for now.